G'day everyone, welcome back to Pete's Investing Updates. We review the weekly progress of a sample of some blue chip stocks across Australia, US and Europe. This week's summary, we review our revised strategy on trading on the daily chart and adoption of the moving average crossover. So this is different to what we were doing in the last 6 or so months. We've been trading on the 15-minute price chart using CCI as a strategy. But we're still using the average down approach. So again, let's get into it. But as always, if you want me to review a share price, put it in the comments and I'll cover it in a future video. Click on the subscribe button, the notification bell, and like the video to support the channel. So let's get stuck straight into the data results. So one thing to notice here, again, we're looking at the daily chart, and I've gone back to 2007. It's a January 2007 in terms of looking at these charts. So we're looking at the same companies over that period. Now, obviously, we're going to be earning a lot more in terms of profitability over the almost 15 plus years as opposed to 18 months. And also a drawdown will be somewhat different as well. But the key thing to note is the monthly revenue average is still between $400 to $500 income. So that's really the key. Again, we're looking at these 7 stocks, and we're investing at any one time, we're investing at least $14,000 if we're trading $2,000 lots in each of these. I've got also here the dividend yield for each of these. And these are taken off Yahoo Finance when the ex-dividend dates are shown there. Now, the reason that dividends are important is, as always, our strategy is that if the stock goes sideways or goes down and we don't sell it to gain our profits in terms of any buying low and selling high, we're at least getting a dividend return, and that's a secondary income stream for our strategy. So let's get stuck straight into it, and let's look at Commonwealth Bank first. So again, we're looking at the time period from the start of 2007. So if you look down there in the timeline, 2007 January up until today. Now, the reason I've gone back to 2007 is I wanted to capture the GFC. So you can see here, we first entered this trade, and this applies to all of our companies that we're trading. But you can see here, we entered the trade back here, our first entry in March 2007. We sold out of it. Then we entered another trade there, also in June. We doubled up our positions with more, buying 36 shares there. We sold out again there. Then we bought another lot. So you can see there, we sold that little profit, and you can see there that the profits gained. Bit hard to read, blow it up a bit. So that was our first trade there. We bought a first lot of shares and we sold it out. We made $141. We bought our second lot of shares to trade. We doubled up, we averaged down. We bought our second lot in the same trade. We haven't sold them yet. Up until there, we sold out. So at that point there, we had $453 in our account. Our break-even point profitability is $100,000. That's our starting balance. But as you can see there, we bought at the peak again, at the peak of that little price chart when the GFC hit in 2008, 2009. So the price fell substantially. We ended up buying our first position and our second position there, and the price fell. We ended up buying our next position there, another position there, there, and there, until we finally sold out. You can see there the price, the profitability was $3,000 and just under $3,500. $3,500 on that GFC trade. We opened up our profitability at about 423. So we made about $3,000 in that year and a half of trading, but also holding it during the GFC. So again, the key to this strategy is not entering too many times when the price goes against us, but also gaining some potential dividends if the company pays dividends during these harsh times for our strategy to work. So if you look at the big picture, we've gained from 2007, we've gained $11,000, just over $11,000 from our starting salary of $100,000, and that is shown here, $11,000 profitability. The drawdown of $5,000. Now what that drawdown is simply taking the highest peak of profitability to the lowest peak. So let's assuming it was that point there. Let's just draw a just eyeball it, and we'll draw our ruler, just about $5,000, and that's probably that's just by drawing it there, it's about $5,000, and that's what that reflects, $5,000 there. So on average, we're receiving $63 a month overall for the period, 175 months of trading CBA. Now, just looking at the last few days or the last week of trading, so you can see there we entered these spikes down here indicate where the crossover happens, the exponential moving average 9, moving average 20. Whenever it crosses over, we buy. Now, part of our strategy as well is, going back to this, we enter when the exponential moving average 9 crosses over the EMA 20, and we close it when the EMA 9 crosses below the moving average 20, and we have a minimum gain of our high-low range of the last 100 bars. You've been following my videos, you'll know that we track the average high lows of the last 100 bars. We track the highs and low range. So when you break even or when you sell out, we need to make sure that the price has gone at least the high and low range of the last 100 bars to be able to close out at a profit whenever that moving average 9 crosses below the 20. So that's how our exit strategy is calculated. It's a minimum gain of a high low range of the last 100 bars. As well, we need to make sure the exponential moving average 9 drops below the moving average 20. And the reason for this section is we want to make sure because we don't want to exit at a small or no profit only if the EMA 9 drops below the EMA 20. We want to gain at least a minimum range of the last 100 bars range. So you can see there we open up a new position and we're also trading $2,000 lots. Again, going back to our table, each of these trades we enter $2,000 lots, hence the $14,000 invested. For each at any one time, we've got about $14,000 invested. So that's our Commonwealth Bank of Australia. Let's look at now BHP. Let's look at the daily for the last few days first, what it's done in the last week. So it's gone pretty much, it opened up here at that point there for the week. Hit a bit of a peak and the EMA just starting to drop down a bit. But according to this, if we open up our initial entry back here in February, we doubled up our positions there. And it's been going fairly sideways, most of it, and it's actually broken above there at the moment. So we're actually in a profitable stage at the moment. So if you look at our ending profitability, it's 10,728, whereas there it opened profitability 10,361. So it's gained about $300 to $400 already from our opening back there. Let's look at the big picture for BHP. So again, looking at the GFC, it opened up at, let's drill down on that one. It fell off. We had a single trades there. It made an entry there. Then it doubled up, multiple entries there. And it finally closed out. At that point there, you can see there as it averages down, the profitability also is lower range required to break even and make a profit. So you can see there the profitability was 2,849, where it opened up back here, 909. So I made about $2,000 in that range as well. But again, looking at the big picture, the other thing to consider as well is COVID. So if you look back here at the start of 2020, so it opened up back here in end of 2019, opened up our first positions of $2,000 worth, held it for most of that time. COVID hit, dropped, we entered another position at the bottom here almost. When COVID started, it started recovering. So we've entered twice in this particular range, and it closed out the profit. So again, it closed out a profit here, 9,940. Opening balance at that point was 9.3. So 9.3 to 9.9. So I made about $600 to $700 of profit in that range post-COVID. Okay, that's BHP. So again, BHP is doing nicely, 10,700. 10,700 in terms of profit with a drawdown of 7,200. So about $61 average per month. Next we look at Volkswagen. I'll go through these a bit quicker, but you get the picture anyway in terms of the strategy. So I'll just talk very briefly about the effects since the GFC. Here the GFC, Volkswagen is doing quite nicely. Had a nice big spike there that it dropped off. You can see there the positions were held for a couple of years, and that's where your dividends would have come into play to pay you back some level of return on your investment in these particular holdings. But the overall Volkswagen has been going sideways most of the time, and it's been making a nice little recovery back here since start of 2020. It fell off COVID, but then it made some nice spikes again. But overall, the returns for Volkswagen, 17,880, the drawdown of 10,800, and a return on a monthly average is about just over $100. And again, we look at €100, I should say. Remember, we're trading each of these in the respective currency. So for the BHP and Commonwealth, we're looking at Australian dollars. Volkswagen, Telefonica, we're looking at euros. And JPMorgan, Johnson, and Caterpillar, we're looking at US dollars. But I've just rounded up to as a dollar amount, just as a rough currency. So that's Volkswagen. And again, I'll go through this fairly quickly. Been doing quite nicely the last few days for Volkswagen to trade. Let's keep an eye on that. But that's in terms of profitability, 17,880. Our starting profit was 17,600. So it's made about $200 already. But we want to make a bit more than that to give us a return. Next, we look at Telefonica. While the chart's loading, I'll just show you Telefonica. That's in the red at the moment, and I'll show you why that's happened. It's because it's still accumulating trades. So overall, let's look at the big picture first. You can see here during the GFC 2008 had a massive drop off for Telefonica and a nice little recovery, and it returned our profits back here when those positions closed. You can see there another little multiple trades there. Multiple entries into one trade was entered there, closed out with a profit there. It went down, we held our positions, multiple entries into this particular trade, it closed out there with a profit. As you can see, each time it closes out these multiple trade entries, when it averages down, it always increases our profit. We never go backwards. Then had some nice little trades there, and this is the biggest one here. Since 2017, Telefonica has been dropping radically. Had a big drop down here, so it's dropped off about €8,000 from our break-even point of 100,000. You can see it's approaching our $100,000 baseline here. Last couple of days, since last week, it's actually broken nicely above our EMA's crossed upwards, but it's still holding on. So we haven't gone into a profitability stages as yet for this particular stock. I like showing stocks with this sort of drop off to show you how the strategy works and how it may affect your expectations and profitability. Next, we'll look at JPMorgan. Again, looking at the data. Now, by the way, Telefonica pays about 10.5% return dividend, and you can see there the returns for each of those if you get caught into long-term holding in any of these. JPMorgan has generated about $15,700 with $11,000 in drawdown, and it equates to about $90 average per month revenue. What does the chart look like? You can see here. And so post GFC, during GFC, obviously had a bit of a drop off, stabilized, and started appreciating since then. And at last few months, or this is the COVID trade, it entered a little trade here, buy and then sold that one there. Entered another trade there and peaked there, then it fell off due to COVID. We entered another entry there, number of $2,000 of shares. Then it's done quite nicely and it's come up and it's closed at a profit there. You can see there, if I leave the cursor there, you can see the profitability up there was 15,700, and that started from a profitability level of 13.5. So I made about $2,000 in that in 2020 and when it closed out at the start of 2021. As you can see here, it opened up again in March, and we've been holding that position. It's been going sideways since, although it has broken above the EMA 9 crossover from the moving average 20, and that's potentially another. If you weren't already in the trade, you could potentially buy it there, and that's what those little spikes indicate. Next, we'll look at Johnson & Johnson. Let's look at the previous few days first. It's been going quite nicely in the last few days. If you've entered the trade there, you'd be doing quite nicely in terms of profitability. So let's look at 10.2. If you started off back here, you'd be making from 10.1. So you're making about $100 already on that trade if you're trading $2,000 US dollars in that particular trade. Big picture on Johnson & Johnson. That's been going quite nicely. You can see there, GFC, not a huge impact, although it kicked in, the drop kicked in later in 2008, I should say. Been going sideways for a number of couple of years, and then it finally started appreciating. Maybe there might have been some works in terms of vaccines back in the middle teens. Who knows? I'm not here to be a conspiracy theorist, and I'm not even going to suggest any political maneuvers on these. You can see here as well, 2020, big drop off, and then it appreciated very sharply, like a V recovery, went sideways, and then it appreciated after that. I did a video on vaccines a couple of months ago. Look it up in my playlists to see how they performed. And the reason for that video on vaccine companies was purely to show the chart relationship with any market news that you may be hearing in terms of vaccine performance. So that's a video I did recently, and I may redo that again, given it a bit of progress and see how things have been going since. Lastly, let's look at Caterpillar. So you can see Johnson & Johnson has been returning about $58 average per month, with $10,000 over the period since 2007. Caterpillar, while we're here, that's generated $13,800 in revenue, with a $7,500 drawdown, and $79 average per month. So again, big picture for Caterpillar. GFC period, it did drop off like most other companies did. We averaged down our positions there, but it closed out early 2010. And it's been going sideways for most of those last 10 years. It rose from 2016, had a nice little recovery, dropped off again, and then a massive recovery now since 2020. You can see there, GFC had an impact, bit of a drop off, then it's been a gradual rise since, and it's been dropping off again. And that's basically probably just a longer term adjustment back to the general trend on the stock price. Okay, that's our results for the blue chip shares. So again, our primary goal in blue chip shares is to gain a revenue stream, and again, that's very similar to what we've been doing on a 15-minute time frame. If you've been following my previous videos on the blue chip stocks, but I thought I'd test it on a daily chart using a different strategy, and that's also generating about $400 to $500 a month in revenue, trading these 7 stocks to be consistent. I just wanted to show the 7 stocks always, and that's allowing for a $2,000 lot investment for each trade. Okay, feel free to subscribe, press the like button, and we'll speak to you guys next week.